Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Ahmad Hakeemul Amin bin Edi Zamri. My matrix number is 2021856056 and I'm from JBA 2423F. In this video, we will talk about capital structure. So the table of content. At first, we will talk about introduction and then we go to the capital structure. What is capital structure? How to determine optimal capital structure? Discuss factor effect capital structure and capital structure decision. It also discuss about financial distress, discuss the integration of tax effects and financial cost distress, discuss agency cost of equity, discuss pecking order theory, and the last, we will discuss about signaling hypothesis. Advanced corporate finance, according to executive education, involves the art and science of effective strategic decision making by implementing corporate financial theory, two cases of financial policy, financial instruments, and valuation. My assignment is to conduct research on capital structure, which is related to chapters 3 and 4 of Advanced Corporate Finance. The first inquiry will mainly be a summary of the capital structure. There is a definition, an illustration, and the significance. The following questions are repeated. It then explores into the ideal capital structure, the variables that influence capital structure and capital structure decisions, economic difficulties, the effect of integration taxes, and the financial cost of equity, the hypothesis, and finally, the signaling hypothesis. So what is capital structure? The specific amount of debt to equity required to fund a company's assets and activities is referred as the capital structure. From a corporation's point of view, equity is a more expensive, long-term source of funding with more financial flexibility. When money is needed, a company with financial flexibility can increase it on reasonable conditions. The total capital of a company can be raised in a variety of ways, including shares, debt, instruments, and other long-term borrowings. The capital structure refers to the various types of securities and the corresponding amounts that comprise capitalization. It is derived from a variety of long-term sources, including retained earnings, equity shares, preference shares, debentures, and long-term loans. So next, we move to how to determine optimal capital structure. The optimal capital structure of a company is the best combination of debt and equity financing that provides the maximum market value while significantly reducing capital costs. In theory, debt financing has the lowest cost of capital because it is tax deductible. Excessive debt, on the other hand, raises the financial risk to shareholders as well as the required return on equity. As a result, businesses must figure out when the marginal benefit of debt equals the marginal cost. The optimal capital structure is calculated by calculating the debt equity mix that minimizes a company's weighted average cost of capital while increasing its market value. The lower the firm's cost of capital, the higher the present value of future cash flows discounted by the WACC. So next, we move to the factor effect capital structure and capital structure decision. For the factor effect capital structure, there is 10 factors. First is business size, second earnings, third competition, fourth stage of the life cycle, fifth credit worthiness, 6. Management risk attitude, 7. Control, 8. Capital market situation, 9. Taxation policy, and the last one is cost of capital. For the capital structure decision, there is 3 steps. First step is the total amount of long-term capital required. This is related to the company's capital budgeting decisions. Second, funding sources from which funds are raised. The last one is total fund composition. Example, the proposition of each specific source in total capitalization. For the financial distress, when a company or individual is unable to generate enough revenue or income to meet or pay its financial obligations, it is said to be in financial distress. This is usually the result of high fixed costs, a high percentage of illiquid assets, or revenue that is vulnerable to economic downturns. Financial distress can occur as a result of poor budgeting, overspending, and excessive debt load, a lawsuit, or the loss of employment. In corporate terms, the term financial distress refers to a company's inability to pay its creditors or when a promise to creditors is broken. It is also known as having insufficient revenue or income to meet financial obligations. Financial distress may be one of the reasons for the company's insolvency. Firms or corporations are sometimes aware of the situation, but they tend to ignore it because they only want to generate profit. Without a quick solution, the burden will continue to grow, potentially leading to bankruptcy. So we move to the next slide, the integration of tax effects and financial cost distress. Financial cost distress is essentially the cause of a financial distress situation in which a company is unable to repay obligations and liabilities. Common examples of financial distress costs include indirect costs, conflicts of interest, bankruptcy costs, and higher costs of capital. The likelihood of distress in this situation is low due to the current value of the minimal distress cost. As a result, the present value of this expenditure will rise with every minor increase in the debt's value. It will eventually equal the increase in the tax shield's present value. In this case, tax breaks will significantly increase bankruptcy rates, lowering firm value. Examine the graph in this slide to see how the cost of financial distress and the tax consequences are merged. So, this graph shows how the present value of tax shields on debt rises as the present value of the cost of financial distress rises. As a result, it is clear how both are interconnected. So in the next slide, we will talk about agency cost of equity. The agency cost of equity is the cost that a company incurs as a result of issues raised by its management and shareholders. For example, the cost of a problem caused by a conflict between shareholders and management's overall interest. An agency cost of equity is also included in information asymmetry. Shareholders bear such a cost when managerial interests do not align with their own. Managers, for example, may make decisions that reduce the firm's value. The disagreement between firm management, CEOs, and shareholders is referred to as agency cost of equity, one of the types of agency costs. Conflicts like this are also sometimes referred to as situations in which one party is motivated by different interests than the other. For the next slide, we will discuss about pecking order theory. The pecking order theory, also known as the pecking order model, is concerned with the capital structure of a company. Stewart Myers and Nicholas Maslow popularized the theory in 1984, stating the managers considers sources of financing in a hierarchy. The pecking order theory is based on the concept of asymmetric information. Asymmetric information, also known as information failure, occurs when one party has more better information than another, resulting in an imbalance in transaction power. External users such as creditors and investors typically have more information than company managers about the company's performance, prospects, risk, and future outlook. External users demand a higher return to compensate for the risk they are taking as a result of information asymmetry. External sources of finance, in a sense, demand a higher rate of return to compensate for the increased risk associated with information asymmetry. Last but not least, we will discuss about signaling hypothesis. A signaling approach is the use of various market signals and patterns as indicators for initiating trades or position. Technical analysis is frequently used to fuel the signaling approach, which alert generated from price chart technical studies initiating and completing trades. However, the approach is not limited to technical triggers. Other sources of information, such as market sentiment or macroeconomic data, can also be used. Traders can employ a signaling strategy on any type of security or asset as long as they trade with adequate liquidity and publish prices and other relevant data on a regular basis. Since it is based on readily available data such as price, volume, volatility, timing, and derivative pricing, technical analysis is much easier to define and research. Some other methods use dividends to forecast a company's future growth. If a company's prospect and cash flow are favorable, its executives are more likely to declare large dividends according to this theory. Dividend increase have historically preceded stock price increases. Anyone can use a company dividend history to draw conclusion about its financial health because it is public information. So, I think that's all from me. Thank you for your time and thank you for watching.